I have 10 o'clock, so good morning, everyone. Thanks for joining us for today's webinar. It's a special webinar on financial risk for farms, and we're really glad that we had so many attendees sign up for today. My name is David Paxton. I'm a Senior Vice President of Risk Management Solutions at Bankers Bank. I'm also a certified community bank risk specialist. This program today is brought to you by Bankers Bank, the Midwest's leading provider of correspondent banking services to community banks. As an independent source of non-competing financial services, Bankers Bank provides a market of over 600 financial institutions, provides a strong portfolio of innovative solutions to help our community banks thrive and focus on the needs of their customers and communities. Before we get started, just a couple of logistics. Due to the number of attendees, your phone lines have been muted. I'm sure we're going to get questions today, so submit those via the chat box on Teams. And due to the length of the program, we're not going to get to questions during the presentation, but we're going to gather all those up afterward and make sure we send those back out in our follow-up email. So any questions you have, even if you send them in the middle of the presentation, that's great. We're going to collect those and send those back to everyone. And since this program is going to take up the full hour, again, we'll get to those. We're recording this webinar, so we'll share a copy of it with you along with the slides to all attendees. And there's also an appendix in the materials that are going out today. So whenever we get those, it'll have some additional information in there. And there's also a short survey at the end, so complete the survey. Let us know what topics you'd like to hear. And today's webinar was definitely a request, so ask and sometimes you will receive. Our agenda today will cover farm financials, bird flu update, farmland values, tariffs and trade, and some macro indicators. We're going to get a lot of good information for you all today. Presenting today is Dr. Gerald Mashangi. He's at the University of Illinois Urbana-Champaign. Thanks for agreeing to join us today, Doctor, and I will turn things over to you.
All right, thank you, Dave. So my name is Gerald Mashangi. I'm an assistant professor here at the U of I. I'm based in Urbana-Champaign, and I teach agricultural finance. I'm also with Extension. I'm on the Farm Doc team, so some of you may have seen some of my articles. But if you're not signed up for Farm Doc, I would highly encourage you to do so, especially if you want to be kept updated on all things related to ag and ag policy as well. So let me see, I need to, Dave, how do I take over control of the screen?
Should you just share the monitor that you'd like to show?
Oh, okay. Sounds good. I'll just do that.
Yeah. Sorry, Dr. Mashangi's our first visiting guest, so there we go.
Okay. So let's get the mix. Okay, so let's dive in. So the U.S. farm sector is still consolidating, as you can see in terms of the demographics of farms and farmland. There's been a sizable shift over the years. So currently, as of 2024, the number of farms in the United States stands at 1.88 million. But when you look at the average farm size, that's actually increased to 466 acres per farm. So you have far fewer farms today, but the average size has increased. And if you also take a look at the orange line, this shows the acres of land in farmland. You can see that since the 1950s, this has actually declined. And although we have far fewer farms today, our agricultural output is actually much, much larger. In fact, total agricultural output has increased 3x since 1948. So what we really have here is a story of efficiency and productivity. And just to illustrate that, what you see over here is that agricultural output has been trending higher, while total farm inputs have declined slightly for the most part. But again, the main takeaway here is that our productivity has been phenomenal. And this explains how, even though we have far fewer farms today, we're able to feed a lot more people. Now, looking at farm incomes, so in 2025, the USDA is projecting that net farm income is going to increase to $180 billion in 2025. They're also forecasting production expenses to remain relatively unchanged compared to last year. So the increase we're going to experience in gross farm income is really going to go straight to the bottom line. Now, we're seeing two particular divergences happening in the ag sector. So on one hand, livestock is doing pretty well, whereas grain crops aren't faring as well. So looking at the total value of production over here for crops, right, that's projected to come down to 235.9 billion in 2025, whereas the total value of animal and products production is forecasted to increase to $299.4 billion. Now, just to get a better understanding of what the components are of the different types of production, when it comes to crop production, the largest share is feed crops, oil crops, and all other crops. Now, as you can see, since grain prices have been coming down since 2022, you're seeing how the value of crop production has also been falling with it. For livestock, what you're seeing here too is that the largest share is meat animals, which constitutes, again, the largest share, followed by poultry and eggs, and dairy products and milk. Now, in terms of value, you can see that the largest share is meat animals, and since 2020, that has been steadily increasing. Now, when it comes to cash receipts, for the total sector, we're expecting $535 billion of cash receipts. But again, that divergent story that I just mentioned, you're seeing it play out here with cash receipts. So for 2025, that's forecasted to increase for livestock to $299 billion, whereas for crops, that's being forecasted to come down to $237 billion. Now, we can take a look at a few commodity prices just to get an understanding of what's really going on over here. So when it comes to feeder cattle and live cattle, you can see that that has increased by the most since 2022. And so what we're seeing is that there's herd liquidation going on and supply is tightening. And the national cattle inventory has fallen to its lowest count since 1951. Also, just switching it up and looking at input costs, what we're also seeing is that input costs for livestock farms, if we're using 2011 as our base year and tracking the prices paid index. So for 2011, we're saying that that index value is 100. And so from 2011, tracking how those expenses have changed over time up until to date, you can see that for livestock farms, input costs have actually increased by a fair amount more than what you've seen with crop farms. Now we can take a look at the overall farm sector and actually examine the different pieces of production expenses. So for 2025, the USDA is forecasting that total production expenses are going to come in at $467.4 billion, which is an increase of 12 billion compared to last year. Now, if we adjust for inflation, we're looking at the same amount of production expenses as we saw in 2024. Now, in terms of the composition, the largest share of production expenses are actually feed, followed by livestock and poultry, and labor. Now, in terms of feed, that's being projected to come in at $69 billion, with livestock and poultry being projected to come in at $60 billion. And labor is projected to come in at $54 billion. Now, we've taken a look at the farm sector. We've got an idea of what's happening in terms of the big picture. We can now look at farm financials. So here at the University of Illinois, we partnered up with the Farm Business Farm Management Association. And what's amazing about the data that they provide us is that we get to see a pretty detailed view of what's happening on the farm. We do have the largest agricultural producer database in the country. And so it is the best and richest data set. And the next best would probably be Kansas State with their KFMA data set. So what we can do is we can take a look at these farm financials and try proxy what's happening in the grain market and looking at how grain producers are faring. So what we try to do is we follow the Farm Standards Council and use the Farm Financial Scorecard. And what's great about the scorecard is when we report on financial metrics, we're also able to tell audiences like yourselves what the financial quality is of some of these metrics. So we're going to start off by examining liquidity first, and then we're going to move on and look at solvency. And so starting off with liquidity, here we're looking at working capital to gross farm returns ratio. And we're also going to be looking at the components that constitute the working capital to gross farms returns. So you can imagine typically you would see a ratio, but if a ratio goes up or down, why is it going up and why is it going down? So here I'm going to present two panels for you. In the top panel, I'm going to be showing you the working capital gross farms return ratio. And using the coding for the scorecard, if the working capital to gross farm returns ratio is above 0.3, that is considered as a strong ratio. And if it's between 0.1 and 0.3, that's in the cautionary range. And if it's less than 0.1, that's considered vulnerable. And as you can see, since 2014, the working capital to gross farm returns ratio has been pretty strong. It did, however, fall by 10.3% in 2024. But again, it remained in the strong category. Now, looking at the lower panel and trying to understand what's actually happening. So because we've seen gross farm returns decline since 2022 as grain prices has fallen, the ending inventory value has also declined with falling grain prices. And what that has resulted in is current asset values decreasing. But at the same time, you've also seen that current liabilities have also increased over time as well. And what that has done is it's shrunk working capital. So you can see that at the median, working capital has been declining. And so this partly explains why we see this drop off in 2024. But in summary, at least at the median, we're seeing that the working capital to gross farm returns ratio is fairly strong. And half of grain farms in Illinois are going to have a ratio that is greater than 0.67. Next, we can just go back to the farm sector level and start thinking about solvency. So what we have over here is the US farm sector metrics for assets, debts, and debt to asset ratio. And the ratio is shown in the top panel. So nationally, debt is projected to rise about 5% in 2025 to roughly $592 billion, while assets are projected to rise to 4.42 trillion. Now, if you look at the debt to asset ratio, that's projected to come in at 13.4% in 2025, which is slightly higher than 13.36 in the previous year. Now, we have data here from 2003 to 2025, and overall, in terms of assets, they've increased by 234% over this time frame. And for debt, that has increased by 226.8%. So in terms of all the increases in assets and debt, what we've seen is that for the farm sector overall, the debt to asset ratio has been within a tight range of 11.28% and 14.1%. Now, the limitation of just looking at the farm sector level is you really want to know what's happening at the producer level, and you also would like to know what the distribution of this ratio looks like. What share of producers have a debt to asset ratio that's strong versus cautionary versus vulnerable. So using our FBFM data set, we can actually do exactly that. So what we have over here are quartiles of the debt to asset ratio, where we look at the lower quartile, the median, and the upper quartile. And now also using the farm financial scorecard, we're going to be categorizing this ratio by its quality. So above 60% will be considered as vulnerable, 30 to 60% will be cautionary, and less than 30% is going to be strong. And as you can see, most grain farms, so if you're looking at the lower quartile and at the median, they are all within the strong region. So for the lower quartile, this came in at 6.37% in 2024. So about 25% of grain farms in Illinois have a debt to asset ratio that is less than 6.37%. At the median, that's 18.23%. Now, for the most levered of grain farms, we're seeing that debt to asset ratio increase to 34.07% in 2024. So about 25% of grain farms have a debt to asset ratio that's actually greater than 34% in 2024. Now, we can also think about assets and debt on a per acre basis. So we're standardizing size here and trying to get an understanding per tillable acre, how much assets do grain farms hold? And per tillable acre, how much debt do these grain farms hold? And we're also going to be looking at the quartiles again, just to get a better understanding of the distribution of these metrics. So starting off with the lower quartile, what we have over here is that the lower quartile for assets per tillable acre came in at $3,060 in 2024. So what this means is that 25% of our grain farms have assets per tillable acre that are less than $3,060. On debt per tillable acre, that came in at $355. Looking at the median, that's a little bit higher. So about half of our grain farms have assets per tillable acre greater than $5,061, whereas about half of our grain farms have debt per tillable acre that is greater or less than $811. And lastly, at the upper quartile, assets per tillable acre came in at $8,802 in 2024, whereas debt per tillable acre came in at $1,425. So because we're at the upper quartile, 25% of grain farms have values that are greater than these values that I'm showing on the screen. Now, we've taken a look at assets and debts. We can also think about cash flow and debt servicing costs and how interest expense is being paid out on a per acre basis as well. So what we have here is interest per tillable acre. And we've also calculated these quartiles to see that distribution. And as you can see, for the lower quartile over here, that came in at $8.33 at the lower quartile, while at the median, that came in at $29.34. You can see that on a year-over-year basis, the increase at the lower quartile was not as large or as substantial as it was for the median. But when you look at the upper quartile, you have a substantial increase since interest rates have gone up. So looking at the upper quartile over here, that is for the most indebted farms, they're now paying $59.86 of interest expense per tillable acre. Now, we've also seen that there's a slump in the farm machinery and equipment market. So what I'm going to try to show you here from the borrower's perspective is what's happening with farm financials and why you're seeing a lower demand for farm machinery and equipment. So we're looking at the capital replacement and term debt repayment margin. And because this metric is a dollar value measure, we're going to have to take our sample of farms and categorize them by the size of the operations. So we're going to be comparing small grain farms against medium-sized grain farms against large grain farms. And by doing so, we're also going to calculate the lower quartile, median, and upper quartile. Again, here we're just emphasizing the distribution just to understand what's going on and what the variation is across time. What sticks out is that when you're looking at the lower quartile, median, and upper quartile, in 2022 for grain farms, this was a great time, but you see that from 2022 to 2023, you see the compression in the margin. So starting off with the lower quartile, we go from $3,018 in 2022, and that falls to negative $55,110. You also see a negative margin 2023 at the median as well. Although the upper quartile did not go negative, it still did experience a substantial compression in its margin. You see the same trend for medium-sized grain farms as well. So here we're going to be defining medium-sized grain farms as those that have gross farm returns that are between $350,000 and $999,999. Again, you're seeing the same trend at the lower quartile and at the median. You're seeing that decline where we're going negative in terms of margins. But for the upper quartile, that's still positive, but a far cry from 225,834 that we saw in 2022, where in 2023 that fell to 47,000, and in 2024 that fell a little bit further to 43,251. And lastly, we're going to see the same trend for large grain farms. Now, the only difference here is because these farms are greater, the magnitude of these margins are going to be larger. But again, you are seeing the same trend. Margins are being compressed. For those at the lower and median, they've turned negative. And for those at the upper quartile, they remain positive. So this partly explains what we're seeing, at least from the borrower's perspective, of what's happening with their balance sheet. Now, taking a look now at the actual farm machinery and equipment market, we actually released a FarmDoc article a couple of weeks ago. So if you'd like to take a look at this, please go to the FarmDoc Daily site and read up on it. But what we have here is that on the left side of the screen, we have our figure from the Creighton University's Rural Main Street Index, where we're looking at monthly farm equipment sales. And what sticks out immediately is that this has been trending lower over time as the demand for farm machinery has gone down. In terms of prices, the producer price index for agricultural machinery and equipment, you can see that those are run up in prices where price changes on a monthly basis compared to a year ago were sharply increasing, but that has since cooled off and has leveled off in recent months. We're also seeing that for total inventories, that has come down by quite a bit. We're now sitting at $5.65 billion as of July 2025. What we're seeing is that manufacturers are trying to realign their inventories with that of dealers as the demand for farm machinery and equipment declines. John Deere and CNH have announced that they will be have announced multiple rounds of layoffs. And we've also seen that CNH has also made an announcement that they'll be closing one of their plants. So they're scaling back on production. And again, you saw from the borrower's perspective what's also happening on the balance sheet. Lastly, just taking a look at farm financials. This is data coming out of the KC Fed, the survey of terms of lending to farmers, which some of you probably may have filled out. But what we're seeing from the loan data is that when it comes to loan volumes, that we're seeing a softening in loan volumes for farm machinery and equipment. So that covers farm financials. We're now going to just move over to an update on bird flu and how that's impacting the poultry sector and also now the dairy sector as well. So just starting off here, what you see is that with bird flu, the first case was actually detected on the 1st of January in 2022 in wild birds. And then the first case that was detected in commercial flocks what happened in February 2022. So what we have here on this figure is inventory values. So we have inventory values on the left y-axis here for table egg layers in millions of birds. And then on the right, we have replacement pullets. And as you can see from the onset of the bird flu, you can see how the inventory for table egg layers has been declining as these outbreaks have been intensifying. But fortunately, in 2025, we're seeing that inventory levels are rebounding, especially when we look at replacement pellets as well. In terms of actual egg production and farm gate prices, you also get to see how that relationship correlates. So as we saw the beginning of the bird flu, what you do notice is that table egg production has been trending lower. And as production was coming down, you see with the farm gate prices, you see how they're also responding by increasing as production came down. But by 2023, we saw prices fall, but then we had a few more outbreaks occurring across the country, and we saw prices substantially rise up. I'm sure many of you probably balked when you saw some of the egg prices at the grocery store. But fortunately, again, we are seeing some recovery where production has picked up again, and we've seen prices in 2025 come down. Lastly, we did pick up our first case of bird flu in dairy cattle in March 2024 in Kansas and in Texas. So let's just shift our attention now to the dairy sector. So similar to the overall farm sector of consolidation, we're also seeing consolidation in the dairy sector as well. What you have over here is milk production on the left y-axis and the number of dairy farms on the right axis. And as you can see, the number of dairy farms has been declining, whereas milk production has been increasing. So fewer dairy farms, but production has increased. But we've kind of plateaued since 2021. Now, looking at the fact that we have far fewer dairy farms, the actual size of the herd has actually picked up, especially in 2025. So that's what this orange line is over here. So we have more dairy cows, but at the same time, that's allowed for the average milk production per day to also increase in 2025. And surprisingly, you can imagine with more supply, the all milk price has also come down. So what this figure is showing you is the dairy margin coverage insurance program. And what we can see is that the margin for farm milk came in at $10.94, which was above feed costs in July 2025. But you can also see that the trend in the margin has been going down. But at least this margin is still above feed costs. You also seen that the all milk price has trended lower, and it came in at $20.80 per hundredweight of milk. With that being said, let's now shift our attention to farmland values. So farm real estate has accounted for about a forecasted $3.67 trillion, which represents about 83.6% of the total value of US farm assets. In terms of the average farmland value in the United States, that increased 4.3% in 2025 to $4,350. Now, if we consider how farmland value has changed from 2019 to 2024, we can calculate the compounded annualized growth rate, and that comes out to about 5.8%. And if you adjust for inflation, that comes out to 2%. Let's see. Okay. The next is going to look at a select group of states and also looking at how those farming values have changed. So in this slide over here, what we have is an index value. So we're tracking how prices have changed since 1997 to 2025. And what we're seeing, particularly when it comes to farmland, is that there's a lot of interest from institutional investors that are interested in farmland as an alternative asset. Its capital appreciation has clearly been remarkable, but it's also being considered as an inflation hedge, and it also has the ability to generate returns. And at the same time, it's those returns are uncorrelated with the stock market. So this partly explains why we're seeing a lot more interest from institutional investors that are seeking to invest in farmland. Now, data from the Illinois Society of Professional Farm Managers and Rural Appraisers give us a more detailed look at some of these farmland values. With the USDA data, you can really see soil quality and get an understanding of how soil quality and farmland prices have trended. So with this data set, we have a more granular idea of it. So what we have are 4 levels of soil quality based on the Soil Productivity Index. So we're looking at the average price per acre of parcel sales, where at the top end we have excellent rated farmland, good, average, and fair. And what you're seeing that in 2024, on the top end, so excellent and good soil productivity, those prices actually came down in 2024. Whereas for average and fair, those increased in 2024, although at a slower rate. We can also take a look at more granular data that's looking at currently recent farmland transactions. And this data is coming from acre value. So again, here I have select states just to get an idea of what these recent trends are. So for Illinois, we're seeing that as of the third quarter of 2025, and actually starting from the first quarter of 2025, we're seeing that the average sales price, and these prices, by the way, are adjusted for soil quality, we're seeing that those prices are coming down. For Wisconsin, Indiana, and Ohio, we're seeing that that's been trending higher. Iowa was trending lower since Q4 2024, but has picked up in the third quarter of 2025. With Michigan, you saw a slight decrease in the third quarter of 2025. With that being said, let's now shift our attention over to trade. So the ongoing trade war has been frustrating for many, but it has brought a lot of uncertainty and it's made the Fed's job a lot more difficult. So this is a great chart coming from the Center for Global Development that's showing what the effective tariff rates are as of November 6, 2025. And as you can see that Brazil, India, and China are amongst the highest tariffed countries. Now, let's focus our attention on actual trade and just get an understanding of how tariffs may be impacting the U.S. economy. So in August, U.S. imports came in at $340.4 billion, whereas exports came in at $280.8 billion, bringing the trade deficit to negative $59.6 billion for the month. Now, the motivation behind President Trump's trade war is to reshape the US economy. That is to attract manufacturing back to the United States and also bring in new investment and potentially lower the trade deficit and the fiscal deficit as well. But we've seen that these tariffs have been used as a negotiating tool, but sometimes they've also been used as a punitive tool. And we're starting to see higher prices in goods. And in addition to that, looking at sentiment surveys, we're seeing that consumers aren't feeling too positive about the state of the economy. Now, this is particularly important because if the economy continues to not be seen or perceived by consumers as positive, you may see pressure from consumer sentiment change the Trump administration's domestic and foreign policy. But right now, given what's currently happening domestically and with the recent elections, we're seeing that consumer sentiment is down. Now, when it comes to trade, we can take a look at agricultural trade as well. As you can see that in recent months, we've been running a deficit in agricultural trade. So what we've seen is that the value of agricultural imports are actually now higher than the value of agricultural exports. Consumers are demanding more fresh produce in the form of vegetables and fruits. And what that has done is it's increased the amount of imports coming to the US. And bearing in mind, when it comes to fruits and vegetables, in addition to wine, these are higher value products compared to lower value bulk products like grains. So it's not a surprise that we're seeing a trade deficit in ag in recent months. Now, the hot topic when it comes to agricultural trade is soybeans and China. So what we're looking at over here is trying to get an understanding of the share of soybean exports to China. So before the 2018 China-US trade war, China was purchasing about 50% of all US soybean exports. That's a sizable amount. But this year, and given the way the second Trump administration has been using tariffs, China decided to make it a point to not purchase US soybeans from May onwards. And it was noted. And this is a big deal again because of just the sheer size of the export market for US producers. So we can actually take a look at how their purchase behavior has actually changed over time. So what we have over here is in the blue bars, we have on a month-to-month basis, the average share of US soybean exports destined for China before the 2018 China-US trade war. And then in the red bars, we have the trade war era. So that's looking at average monthly exports to China for soybeans from 2018 to 2025. And it's pretty evident that in most months, the share of soybeans being purchased by China has actually come down. Now, fortunately, China and the US did come to an agreement where China has promised to purchase about 12 million metric tons of soybeans by the end of the year. I believe right now that balance is at 1.1 million metric tons out of the 12 million. But if you take the total from January up until now, and if we do hit that 12 million metric tons target, the total will be 18 million for the year. But 18 million metric tons for 2025 is actually 33% lower than what we saw in 2024. And because when it comes to a trade war, it's going to be tit for tat. The way I'm approaching these purchase promises is just that this potentially could just be tentative. Anything can happen. China can walk away from this agreement if another tariff is imposed or if there are disputes regarding trade between the two nations. Now, the big winner in all of this has been Brazil. Between January and October 2025, Brazil exported a record 79 million metric tons to China. This represents about 80% of the agricultural exports. What's even more interesting is that if you take a look at what's been exported from Brazil from January up until October, that's already exceeded the total that was exported in 2024. Now, for Brazil, there are a few shifts that are also occurring there. What you can see here is that production has ramped up in Brazil as the amount of acres dedicated to soybean production has also increased. We've gone from 84 million acres in 2016 to 121 million acres for the 25-26 marketing season. Now, for comparison, if you compare that with the amount of acreage planted in the US in this current season, that was only 81 million acres. Now, the big push behind this expansion in acreage is that in Brazil, there is strong demand domestically and obviously internationally. But at the domestic front, they have a biodiesel mandate. And this biodiesel mandate uses soybean oil as a feedstock. So this has been a boom for Brazil soybean producers. Now, Argentina has also benefited from the situation as well. As you may all recall, in September, Argentina had made an agreement with the US Treasury for a currency swap. And when Milei secured the currency swap, he lifted the 26% tax on soybean exports. And what this did is it lowered the price of soybean exports, and China came in and was able to purchase a large amount of soybeans at much lower prices. Obviously and naturally, this upsets US producers and also caught the attention of the administration as well. And this is what also motivated the discussion that we saw between China and the US, particularly when it comes to soybeans. But again, the main takeaway here is that Brazil and Argentina have taken up this opportunity and have been able to sell a substantial amount of soybeans to China. I think the big question we're looking into the future is, will China prefer to trade with Brazil and Argentina, or are they going to re-engage with the United States and fully commit to our soybean exports? For me, I personally still think that's a question mark. This is a very transactional administration. And when it comes to policy, I think both countries have their policy goals. And clearly, when it comes to trade, soybean exports are a pain point for the United States. And it's quite clear that China understands this. They did exactly the same thing in the 2018, 2019 trade dispute, where they also lowered the amount that they purchased from the United States. So looking ahead, let's just keep watching and seeing how this evolves. Lastly, let's take a look at a few macro indicators and wrap up our discussion. So the Fed's preferred measure of inflation is the personal consumption expenditure index. And what we have over here is headline and core inflation. So in August, headline inflation came in at 2.74%, while core inflation came in at 2.91%. If we use more recent data and look at the CPI data, that came in at 3% in September. So you can clearly see that inflation is running well above the 2% target set by the Fed. Now, the question then is, what other inflationary pressures are consumers experiencing? One of those is actually food prices. You can see during the period when inflation was running away, when it comes to food, you see how prices also ramped up during that period before the Fed started increasing the federal funds rate in March of 2022. But prices have come down since then, but food inflation is still relatively high. And again, consumers are feeling the brunt of this. What we're seeing is that in August 2025, we're seeing that food away from home index, so this is going to be food purchased at restaurants, that came in at 3.73%. And then for food at home, so this is food purchased at the grocery store, that came in at 2.7%. Now, what's also interesting is that you're seeing a shift in consumer food consumption patterns and preferences. So what we have here on the left side of the screen is food expenditures from 1964 to 2024, where we're showing the total food expenditures, food away from home expenditures, and food at home expenditures. Now, total food expenditures for 2024 came in at $2.58 trillion. And this was mainly driven by increases by expenditures for food away from home. Now, if you take a look at the share of food away from home of total food expenditures, that came in at a high of 58.9%. Now, if we take a look at how consumers are shifting the way they use disposable income, this is the figure on the right over here, where we're showing the share of disposable personal income spent on food from 1964 to 2024. What becomes very apparent is that in 1964, about 15% of disposable income was spent on food. But you can see how this has come down. And in 2024, this came in at 10.4%. Now, you're seeing a similar trend for food at home. So the share of disposable personal income has also come down. And by 2024, this came down to 4.9%. Looking at food away from home, this actually came in at 5.5% in 2024. But what's interesting is that despite the COVID blip that we had over here where we couldn't eat out, you can see that now as a share of disposable personal income, consumers are spending a larger share for food away from home compared to food at home. So lastly, we're going to discuss some of the consumer sentiments that we're seeing from a few providers like such as the Conference Board. So this is the Consumer Confidence Index, where 1985 is set as the base year at 100. And what you can see is that in October 2025, this fell by 1 point, where the index fell to 94.6. Now, you see exactly the same trend from the University of Michigan's US consumer sentiment, where this fell to 55.1%. Now, as I mentioned earlier, how the voter feels about the economy will likely have an impact on domestic and foreign policy as we head to the midterms. Now, the president isn't mincing his words in that he is demanding lower interest rates to help consumers. However, from the Fed's perspective, lowering interest rates isn't appropriate right now. We saw a very interesting Fed action that happened with the last two rate cuts. We have a softening labor market, but inflation is still running well above 2%. And although the Fed has a dual mandate, in that particular decision, they had to pick one over the other, and they decided to prioritize the labor market. Now, amongst FOMC officials, there's debate on whether or not in December rates should be cut or held where they are. We've also seen that a few Fed officials have said that they would rather keep rates steady, while others are suggesting that it wouldn't be bad to see rates lowered in December. We had the government shut down as well, so we have missing data. But fortunately, the Fed also has alternative data sources as well. So we're waiting to see what that outcome will look like as well. Now, to further complicate the thinking behind all of this, particularly as we start thinking about the state of the economy, is the ongoing trade war and how these tariffs may eventually spill into prices. And we're already seeing that, at least with goods inflation. And this potentially can further hurt consumers as well. But again, when you look at these consumer sentiment indices, and as you guys all know, the Trump administration follows polls closely, and they aren't afraid to shift policy positions. If they deem that domestic and foreign policy is not being received well by consumers, I suspect that there may potentially be further policy shifts as well. Now, last, just looking at inflation expectations, looking at the 5-year break-even inflation rate, we're seeing that the market is expecting that inflation is going to be at 2.36% 5 years out from now. This is slightly higher than what we saw in 2024, where the expectation was for it to be slightly less than 2%. Hopefully, the Fed will make inroads in addressing inflation. But again, as I've said, with the ongoing tariffs that are currently being imposed on trading partners, in addition to the fact that we're seeing that there's a potential slump in the economy, many reports are suggesting that US GDP is being propped up by AI investments. So we potentially may be on the edge of a recession. But again, we need more data just to be able to confirm that. In addition, we've seen market sell-offs as well. Gold prices are a little bit lower. Bitcoin has fallen substantially. I believe it's at $83,000 right now. But again, just looking at it all and just thinking about the big picture over here, the Fed is going to try to achieve a soft landing. But some of the metrics that we're seeing don't look so great. And lastly, just also thinking about the labor market as well. We're seeing some cracks appearing there as well, especially from my perspective with a lot of the students that I teach. I teach an Excel spreadsheet modeling class. In the spring, I had quite a number of graduating seniors that were unable to land a job by graduation. And as reports have been indicating that for the labor market, especially when it comes to entry-level work for recent graduates, we're seeing the unemployment rate there pick up as well. So the Fed has a lot to consider, and so does the Trump administration. But in summary, That is the lay of the land. In terms of ag, 2025 is a story of recovery, particularly for the livestock sector. The balance sheet is strong for the most part, but in the charts that I showed earlier, we were looking at the distribution of some of the grain farms. We're seeing that for some producers, there are signs of stress. And as we look out into the future, particularly as we see how the Fed is going to address interest rates and overall inflation, it's going to be a few things to look out for. That concludes my presentation, and thank you for your time.
Well, thank you, Doctor. That was really informative. Thank you for passing along that information for us today. Um, again, submit your questions that you might have via chat before you leave. We'll keep the session open for you so you can send your chat questions in to us. We'll get to as many as we can in the next few days whenever we send out the slide deck that Dr. Mashangi has provided for us. And again, there's an appendix in there as well. So we really appreciate all that information as well. Well, it's been a pleasure presenting to you today. Thanks for joining us. We hope that you gained some knowledge that you can use right away. Bankers Bank can offer you professional risk advice through our risk management solutions division. So we're here for you and make sure that you respond to our survey so we can plan our next webinar. And hopefully Dr. Mashangi can join us again next year with maybe some good news for the for the ag sector. So thank you all. We'll let you go just a couple of minutes early, and have a great rest of your day.